Hi friends, welcome to my channel. So from this video, we will understand what a mutual fund is and how to select the right mutual fund. So to understand about a mutual fund, we will take an example. So consider that I want to eat a biryani in tonight's dinner. So I have two options here, either to make the biryani by myself or to order from outside. So if I have to make the biryani, then I have to buy the curry powder, the rice, oil, eggs, chicken, etc. and then have to prepare it. But if I am going to order from outside, then I just need to select a hotel, pay the money and order the biryani. After a few minutes, biryani will be served. Here, I don't have to know anything about the preparation. I just have to order, make the payment and enjoy the biryani. This is exactly the difference between direct stock market investment and mutual fund investment. So in the stock market investment, you have to learn about the markets, which stocks are good to invest, when to invest, etc. Here all the decisions will be made by you, but in mutual funds, you don't have to do any of this. You just have to select a mutual fund and start investing on the mutual fund. Your money will be handled by a professional and he or she will be making all the investment decisions for you. So now let us understand what a mutual fund is. As per the definition, a mutual fund is a professionally managed fund that pools money from the investors like you and me and purchase the securities like stocks, bonds, etc. So this means that mutual fund is an organization or a company which takes money from the people, and with this money they will be investing in different instruments like stocks, bonds, etc. This will be handled by professionals who do all the research and analysis and invest our money in the mutual fund schemes. So when the prices in these mutual funds appreciate, we will get the profits for the money invested, and when we exit the fund, the money will be credited back to us with the profits. Hope you got some idea on what the mutual fund is. So now let us understand the different types of mutual funds. So there are basically 5 types of mutual funds. They are the equity mutual funds, the debt funds, hybrid funds, index funds, foreign funds. Equity mutual funds, as the name suggests, this is a mutual fund which will be investing our money in the equities or stocks. Debt funds, these funds mainly invest in debt instruments like government bonds, corporate bonds, etc. These funds are less volatile and usually less riskier than equity mutual funds. Also, they tend to give higher returns than FDs and lower returns than equity mutual funds. Hybrid funds. So this type of mutual fund invests in more than one asset classes, that is equity, debt and other asset classes depending on the investment objective of the scheme. Fourth one is index mutual fund. So these mutual funds invest mainly in indices like Nifty, Sensex, Bank Nifty, etc. Now comes the fifth one, which is the foreign mutual fund. So these funds invest in stocks or sometimes mutual funds outside of India. So most of the popular foreign funds are invested in US stocks. Now let us talk about how to analyze and select a mutual fund. So we will be discussing about equity mutual funds and index funds in this video. Coming to equity mutual funds, there are 4 different types of mutual funds. One is a large cap fund, the mid cap fund, the small cap fund and the multi cap fund. So the large cap funds are the funds that invest in companies which have more than 20,000 crore market capitalization. These companies are the top 100 companies in India. Mid cap funds are the funds that invest in companies with a market cap of above 5,000 crore and below 20,000 crore. They are much riskier than the large cap funds but less riskier than the small caps. Coming to the small cap funds, They are the funds that invest in companies with a market cap of less than 5,000 crores. These are very volatile and can be very risky. But these funds have the potential to give very high returns than the other mutual funds. So for explaining this, I will be using the help of the Groww website to show the funds. This is not a promotion of Groww. I invest most of my mutual funds through Groww. If you are interested in opening an account in Groww, the link is given in the description below. Let us take the example of Mirai Asset Large Cap Fund Direct Growth. In the name of the mutual fund itself, we can get most of the details about this fund. Mirai Asset is a fund house or the company which is going to handle our money. Next, the large cap fund means this fund will invest only in the large cap companies. So the large cap companies are companies who has a market capitalization of more than 20,000 crore rupees. If you check the holdings tab, this fund is investing in 59 companies and all these companies are large cap companies. This also shows us how much percentage of our invested money is allocated in each company shares. Coming back to the name of the mutual fund, we will see what direct means. Most of the mutual fund have direct and regular fund. If we compare the direct and regular fund of a mutual fund, we will see that most of the details are the same except the expense ratio. The expense ratio is the amount you pay to a fund as a percentage of your investment yearly to manage your money. So let's explain this with a practical example. The expense ratio for Mirai Asset Direct Mutual Fund is 0.53% and for the regular mutual fund is 1.57%. So in the money control, if you check the difference, if a person invests 10,000 rupees per month in a regular fund for 10 years, he gets an annualized return of 13.96%. But if that person had invested in direct mutual fund, then his returns would have been 15.1% annually for the same fund. Kindly note that higher the expense ratio, lower will be the returns. So always select the funds with lesser expense ratio. Some mutual funds have exit and entry lots. Here if you see, in this mutual fund, we have a 1% charge in case you exit this fund in 1 year. So this is the exit lot for this fund. The last part of the mutual fund is growth, means this is a growth fund. These type of funds usually invest on companies with higher growth. There are other types of funds like value funds, dividend funds, etc. But the growth fund probably gives more returns than other type of funds. Now we will discuss on what are the different types of investment methods. You can see that there are two kinds of options in the right side. One is the monthly SIP and the other one is one time. SIP stands for Systematic Investment Plan. Means monthly you can invest a fixed amount. Here we can set a date on which day of the month the money needs to be invested. And one time is like bulk investment. I personally prefer SIPs over one time as SIPs are less riskier and less volatile. There is another type of funds called the index funds. Here I am taking ICICI Prudential Index Fund as an example. This fund will invest in Nifty 50 index which contains the top 50 companies in India. So the performance for this fund will be in line with the Nifty 50 index. If you check the expense ratio, it is 0.17 and these index funds usually have the lowest expense ratio. The reason being these funds are called as passive funds and the other funds which we mentioned before are called as active funds. This is a passive fund because even though there is a fund manager for these funds, the fund manager will make a change only if there is a change in the Nifty 50 index. But in active funds, the fund manager has to research on the companies and make changes accordingly. So the expense ratio is more for the active funds. Personally, I prefer the index funds over other mutual funds because they tend to give more than 10% returns historically and also have a very less expense ratio. I hope you got an idea on how to analyze a mutual fund. Now, other things you can consider while selecting a mutual funds are: one is your age. For example, if you are in your 20s, and then you can consider investing a big aggressively in the mutual funds, which means that you can allocate more of your funds in small cap and mid cap and less in the large cap and index funds. 2. Your financials. If you are a person who is having loans, then it is better to invest more on the large cap and the index funds than on other funds. 3. Your risk appetite. If you are a person who doesn't want to see a lot of fluctuations and are happy with a return of around 10 to 12% per annum, then index funds are a very good option. So that's it, friends. I hope you got some value from this video. If you like these kind of contents, please subscribe, share and like the video. Thank you for watching.